Welcome to Sophie Daddy's channel. In today's explainer, we're diving into what feels like a massive turning point for the bond market. We're going to break down what the top analysts are saying to figure out what's really going on here. So let's get right to it. We're tackling a huge question today, especially if you have any investments. You see, after all the chaos of the last few years, this really rare window has opened up for generating some serious income. The big question, though, is that window about to slam shut? Let's find out. Okay, so to really get what's happening, you have to understand that the bond market is playing by a whole new set of rules in 2025. Seriously, the old playbook? It's been tossed right out the window. And this really lays out the huge shift perfectly. See, for the longest time, making money on bonds was all about prices going up. Interest rates would fall, your bond's value would rise. Simple. But now, in 2025, the game has totally flipped. It's all about the high starting income, those regular coupon payments. That income is so substantial now that it acts like a giant cushion, protecting your returns even if the bond's price bounces around a bit. And look, this isn't just some small change. We're talking about major players like Vanguard calling this the defining feature of the market today. This idea, the power of income, is the whole story. It really means that the yield you can lock in right now, well, that's the main event. So you might be asking, why now? What's so special about this moment? Well, it's because the US economy is sending out some seriously mixed signals. It's like a puzzle, and analysts have a name for it: Stagflation-Lite. Think of the economy as being in this massive tug-of-war. In one corner, you've got all the signs of a slowdown. GDP forecasts are getting slashed, the job market is cooling off, people just aren't spending as much. But in the other corner, you have inflation, and it is just refusing to back down. It's staying stubbornly high, mostly because of supply chain headaches and new tariff policies. And that right there is what brings us to this key term, stagflation-lite. Now, it's not the full-blown 1970s style stagflation crisis, but it has the same nasty ingredients, right? Growth is slowing, but prices are still going up. You can imagine this puts the Federal Reserve in an incredibly difficult position. With this puzzle unfolding, all eyes are on the Federal Reserve. They are absolutely the key player in this whole drama. And their next move, well, that's what officially starts the ticking clock for investors. So let's just quickly recap the Fed's journey, because it explains everything. Not long ago, they were in full-on inflation-fighting mode, hiking rates like there was no tomorrow. But now, the data's shifted. The economy is slowing, and suddenly their priority has changed. Now they're talking about downside risks to employment. That's a huge pivot. It's basically a signal to the market that rate cuts aren't just possible, they're expected, and soon. And this is where it gets really tricky. This is the Fed's big dilemma. They're basically being forced to cut rates to prop up the economy, while other policies, like trade tariffs, are simultaneously pushing inflation up. They're trying to hit the brakes and the gas at the same time. It's a super unusual and, frankly, risky balancing act. So with all this drama happening, how's the market taking it? Well, what's fascinating is that we're seeing the return of a classic idea, the good old-fashioned role of bonds as the steady hand in your portfolio. Yep, that classic stock-bond relationship is finally back. Remember that painful stretch when both stocks and bonds were tanking together? Well, that's over. Now we're back to a more normal world where when people get scared about the economy and stocks start to fall, they run to the safety of high-quality bonds. This pushes bond prices up. Bonds are once again that ballast, the heavy weight that keeps the ship steady when the waves get rough. So what flipped the switch? It's all about what's causing the fear. When the big monster is an inflation shock, like we had a couple of years back, it's just bad news for everybody. Stocks and bonds both get hammered. But when the fear is about a growth scare, like right now, it's a different story. A slowing economy is bad for company profits, so stocks suffer, but it's actually good for bonds because it signals that the Fed is about to step in and cut rates. And just like that, you get that valuable negative correlation back. Okay, let's pull all these threads together. We've got this new world of income-driven returns. We have this weird stagflation-lite economy, and we have a Fed that's about to make a big move. So what on earth are you supposed to do with all this? Well, the good news is, the analysis points to a surprisingly clear playbook. Here it is, broken down into 3 simple steps. Number 1, prioritize quality. In a slowing economy, you want to stick with bonds from rock-solid companies. No messing around. Number 2, embrace intermediate duration. The sweet spot, according to the pros, is in that 2 to 10-year maturity range. It's the best balance of opportunity and risk. And finally, number 3, and this is the big one, lock in these high yields. You need to act before the Fed starts its cutting cycle and these juicy yields start to vanish. And just to really hammer home that point about quality, check out what analysts are calling the credit paradox. It's a really strange situation we're in. On one hand, companies are seeing their profits dip and their finances look a bit weaker. But on the other hand, the extra pay, the risk premium you get for buying their riskier bonds, is near an all-time low. It just doesn't add up. It means you're not getting paid enough to take that gamble. The real win, the real prize right now, is the fantastic all-in yield from super safe, high-quality bonds, not from chasing a tiny extra reward in the risky stuff. And this really sums up what pretty much every analyst is saying right now. The dominant strategic play is to move out of cash and extend into those high-quality bonds. The goal? To lock in these yields. Because, and we can't say it enough, that window of opportunity is definitely closing. So, it brings us full circle, right back to where we started. The market is basically handing investors a clear but very time-sensitive opportunity. The strategy seems pretty straightforward. The real question isn't, what should I do anymore? The question is, how much time do I have left to do it?
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.